Well, it's been a tough start to the year. That first quarter, major indices all trending lower amid numerous trade and economic uncertainties. Now, that's a stark contrast to other markets in Asia and Europe, which have, for the most part, been rising. But what about Canadian stocks? My next guest says our market has done surprisingly well given the economic threat we're facing. Michael O'Brien, Managing Director, Portfolio Manager with TD Asset Management. Michael, always great to have you on the program.
Oh, thanks for having me in.
An understatement to say these are challenging times for Canada, challenging times really for the global economy, lots of uncertainty. You're saying that investors are finally waking up to what's happening out there.
Yeah, I think, Donald Trump's tariff threats through the election period and in the immediate aftermath of his victory in November, that was kind of an inconvenient truth that investors wanted to ignore because there was so much excitement around what was perceived as some of the more business-friendly or market-friendly initiatives, deregulation, tax cuts. Who doesn't like that stuff? Unfortunately, what we've slowly been coming to terms with is, in his heart of hearts, President Trump really does want tariffs. I mean, I think that's what's finally sinking into people. And we had a few false starts with tariffs on, tariffs off, tariffs on, carved off. I think finally investors are starting to come to terms with the reality that this is going to be a different trade environment going forward.
And that different trade environment going forward, a lot has been said about really what we're doing here and what we're seeing is a shift in the global order. Well, what do you look for to know exactly where we are in that shift?
Yeah, well, I mean, it's going to be very difficult to track this, development by development, because as we've seen, everybody's getting whipsawed on a daily basis, it feels like. I think, sort of the points to ground ourselves with are, I think our base case going forward as investors should simply be that this post-World War II era that we grew up in, the Bretton Woods era of, freer trades, lower tariffs, that's being unwound. To what extent, we don't know. And so I think that's really where we want to key in on. And specifically as Canadian investors, I think it's very clear that the United States, which has sort of underwritten that entire post-World War II system, is retreating. And so tariff walls are going up. And I think what we want to try to determine as Canadian investors is which side of that tariff wall do we land on? Do the Canadians wind up inside the tariff wall, so in other words, a fortress North America, or are we outside the wall, outside that wall with everybody else, in which case it's America alone? So that's really what we're going to be tracking, and the Canadian governments at all levels are going to have a difficult task of communicating that message. But really, that's what I, as an investor, am going to be keying in on is there a genuine willingness of the Trump administration to negotiate some sort of renewed NAFTA/USMCA where we return to lower tariffs in the North American economy, or is this more of a very protectionist bid that's going to last? And I think at this point we don't know, but that's what I'm watching.
When you talked about how obviously we're seeing some challenges out there in terms of people waking up to the reality of all this, the Canadian market compared to the U.S. market, obviously we saw a big pullback. We saw a 10% correction in the S&P 500. In comparison, we've not been doing quite as bad, I don't think.
Yeah, I mean, given all the headwinds, and if you think about the first few rounds of tariff noise, and more than noise, like, some of the first rounds of tariff implementation, Canada's borne the brunt of that. Whether it was, the original tariffs on Canada, China, Mexico, the aluminum and steel tariffs, which hit directly at Canada, which is the single biggest exporter of those, products to the U.S. We've taken a pretty heavy blow right out of the gate. So I think finishing the first quarter slightly positive is a pretty heroic effort for the TSX composite. What would I attribute that to? I think expectations, in contrast to south of the border, expectations coming into 2025 were pretty measured. Valuations across the board in the Canadian market weren't terribly elevated. So that's a good, good starting point. And then when you look at the composition of the Canadian market, if you think about where the biggest sell-off has been, it's been in the technology space. Canada tends to under-index as opposed to the U.S., which is chock full of, technology companies. On the other hand, gold is one great example. Gold's time to shine, pardon the pun. Canada over-indexes in the gold space. We have, very significant gold exposure. So I think partly it was the composition of the market, and partly it was just the fact that we didn't come in overly exuberant with our expectations, and valuations were kind of in check.
I think it was Churchill who said, never let a good crisis go to waste. If not, people are saying it was Churchill who coined that phrase. We've been hearing a lot about if this is going to be a global shifting order. We're not sure if we're inside or on the outside when it comes to the Americans. Interprovincial trade, try to get domestic demand stoked. How do we view all that from an investing perspective?
Well, I think that falls into that camp of control what you can control, and I think in terms of the various levels of government, the federal and provincial governments in Canada. I mean, that's the task at hand, is seize this moment and make some of these changes that have been difficult to achieve for political reasons over many, many decades. These have been fairly intractable issues, and it's always come down to us versus them, regional conflicts. Somebody over here is upset, but somebody over there wants it. So I think in this moment, from a policy perspective, what we want to see or what we hope to see is stop being Ontarians first, Albertans first, Quebecers first, be Canadians first, and think about what's in the national interest. So sometimes when these crises come along, that galvanizes a moment where things that never seemed possible might actually happen. So it's incumbent upon all these governments to take advantage of that. And I think from the investor side, just in terms of, how can we think about this, I think recognize that even out of a difficult situation, sometimes some positive silver linings can appear. And so don't be blind to that. Don't allow ourselves to be overly focused on the clear and obvious negatives. Also keep an open mind to some of the positives that might spring up on us.
So we're going to drill down now into sectors. Let's begin there. Broadly speaking, cyclicals. Perhaps people want to be cautious there.
Yeah, I would agree with that. I think the reality that we're facing right now is, the tariffs are still being quantified, action, reaction, retaliation. I don't think anybody knows exactly where all this is going to land, but I think one thing that's very clear is this will be a headwind to earnings. And I think you're seeing this across the economy in terms of the ability of households to make major decisions. Probably not the time when you're going to make a decision about buying a house or a car if you don't need to. Businesses, I think, are in the same boat. Do you build that new factory? Do you hire new workers? So there's a bit of a freezing effect that happens given this uncertainty. And clearly there will be some headwinds on actual activity. So I think the moral of the story here is there's going to be pressure on companies' earnings. And so in that type of a market, what I try to do is really focus on the companies or the industries that have the most defensible earning streams, the ones where they're the most certainty that they will deliver the goods.
Now, you talked about the Canadian market and the outperformance, and a lot of that was to do with the price of gold lifting our miners. I think a natural question for people after seeing gold hit numerous record highs is where does it go from here? I mean, are we still looking at gold in this environment, even though it's hitting new records?
Yeah. Well, I mean, gold has always acted as a real nice diversifier across portfolios. It always has this tendency to bob when everything else weaves, and it's done it again. We've hit some difficult times, a lot of difficult news flow out there, and gold has done extremely well. From here, how do I think about it? I'm in no rush to lighten up on my gold holdings, frankly, and the reason is simply that there's a myriad of issues or reasons why one would want to own gold here. If you think about two of the sort of competing impacts of higher tariffs that we're seeing across the globe, is on the one hand it dampens growth, on the other hand it increases inflation, which stagflation is one of the most feared words for investors, for equity investors. However, that's the type of environment gold actually stacks up relatively well. So. I would say at this point, I'm comfortable with the outlook for gold. I don't know how high it goes, whether it goes a lot higher, but I do feel comfortable saying there are worse places to be right now than to be looking at that.
That's gold. Oil, also an important part of the TSX. It's been an interesting move considering we're worried about economic weakness globally, but we have no shortage of sort of global strife. What do you think about the energy-related stocks? And then, our energy being exported to the States.
Yeah. Well, I think oil's an interesting case here. It seems to have found a bit of a comfort level in the high 60s, low 70s. And so the competing forces here, it's not so much a fear of tariffs per se. And I think we learned that immediately in the very first round back in February, March, where President Trump immediately marked down his proposed tariffs from 25% to 10% just for Canadian energy. I think that was the tell for investors that even the Trump administration, despite his bombast about not needing Canadian oil, they realize they do. And particularly Midwest refiners almost exclusively relying on Canadian heavy crude. Gulf refiners very heavily reliant on Canadian crude. There's clearly the need there. So I don't think tariffs are going to be the thing that we have to worry about from a price perspective. The indirect impact of tariffs is where the fear is, it's macro demand. And so I think really the tariffs aren't the driving force here. It's more about does a broader global slowdown eat into oil demand? I think that's, and so I kind of think oil is at a healthy range here. For the companies that produce it, the Canadian producers, 70 is a level where you're not going to blow the doors off, but you're going to make very healthy profits. So for the better producers, they're going to continue to generate strong free cash flow at these levels. Should be good shareholder returns, whether dividends, buybacks. So despite a relatively muted outlook for the commodity itself, I think these companies are pretty well positioned.
All right, if we're talking about a Canadian economy that is under obvious pressures, financials and insurers.
Financials. Well, if we start with the banks, they're obviously a little more in the front line of any economic slowdown that we're going to see in Canada. And where you zero in on is their loan books. And so the good news is coming into 2025, the banks were entering this period from a position of strength. If you look at the capital ratios, very, very strong. And the progression of loan losses that we had seen over the last couple of years seemed to be leveling off. And so the expectation coming into this year was that we would gradually see loan losses begin to fall, which would allow earnings growth to accelerate. I think the difficulty now is it's very uncertain whether loan losses are going to fall or actually begin to rise again as the tariff impacts are felt. So I think that's one where there is earnings risk. Valuation-wise, they're at reasonable valuations today, so I don't see outsized downside if this materializes. But I do think that there's risk to the earnings estimates.
We got 1 minute, so let's get those insurers.
Yeah, so I think the insurers are sort of one step removed from the front lines in terms of, they don't have those big loan books that you're worried about if the Bay goes bankrupt, what's the impact? It does filter through the insurers in some respects. But I think they're a little more insulated. They should hold up a bit better, and particularly the P&C insurers, property and casualty. Names like Intact Financial, very, very stable businesses. So, when I mentioned at the outset the idea of focusing those companies with relatively less earnings risk or, ability to protect their earnings streams, Intact is a good example of the type of company I'm referring to.